answer a question someone asked, and I'm going to start posting more videos. I've gotten pretty bad about that, and you know, so I'm going to start doing that. Please let me know. It's late at night, so I really don't want to. My voice is hoarse, and I don't really want to talk real loud. But let me know if there's something, if the audio doesn't sound good. I got a new laptop recently, so if it doesn't sound well, let me know and I'll work on that. But anyways, let's get to the question. So this person's saying that they've been following Forex for a while, and their problem is that during the Forex trading session, they can read the context well and understand what's going on. However, too often they don't get a decent signal bar and can't decide where to put the stop. And usually they miss the trade altogether. I'm not into scaling in unless I try, and I usually try not to use wide stops since it becomes difficult to use 2 times risk. I've asked you about this issue before, and you once told me when the context is good, it's okay to enter on a stop on any bar. What are your thoughts on how should I resolve this issue? So what are your thoughts, and how should I resolve the issue I'm having? Okay, so I allow y'all to read it, but let me put the question in my own words real quick. So this person, I guess a while back I mentioned about stop entries, and usually you can enter on any bar. You can enter on a stop on any bar most of the time, and that's true, but it has to do with context. And this is the USD so the euro, the dollar Japanese yen forex cross in 6-minute chart. And when I say that, what I'm referring to is when you get a breakout. Let's say here, you're always in long follow through. Your stop's somewhere either here or here or here. It's minimum below this bar. Whoops. So it's minimum below here. So if you buy above this bar, your stop's down here. It is not below this bar. If you buy above here, your stop's down here or here. So the issue with that is what it sounds like what this person's saying is they're using too tight of stops. And, you have to decide in trading, you have to give something up. So if you're going to use tight stops, you're going to get lower probability. And to me, I think it's worth using wide stops and even scaling in times. So, let me think through this for a second. So let's break the question down. Yeah, so this person's saying that during the trading session they can read the context and understand what's going on. However, too often they don't get a decent signal bar and can't decide on where to put my stop. Well, that happens a lot. And the reason the markets are, they're fractal, I can't even think of the word, but it's fractal mathematics. I believe that's the right word. And everything, larger patterns are made up of smaller patterns. So if we look at this chart, if we go to a 240-minute chart, terrible signal bar. 120-minute chart, better signal bar, it's a bull bar. 60-minute, it's okay. 30-minute, well, second entry buy. So, it on some time frame, this will look like a great buy, but you have to understand the context. Context is everything. So, the reality is that it's not that simple. However, too often I don't get a decent signal bar, can't decide where to put my stop, and usually then miss the trade altogether. So, real quick, right here, this tells me right there, I have one question for this person. That is, are you trading too large of a position? A lot of times we don't. Two things. Well, before I say that, what time frame are you trading, and What's the range? So with Forex, a lot of times you get small ranges. Here, 1422 to 1405, so it's barely 20 pips. So it's difficult. I would not be risking. It's difficult to buy above here, put your stop below, and go for 2 times the risk because that's sometimes less than a minimum scalp. And the reality is, whoops, let me fix that real quick. Think about a line chart. If we were trading a line chart, this would be all you'd see. Bear trend, trend line break, test the lows, double bottom, bull breakout, always in long. Bear breakout, second leg down, sideways, maybe a triangle, final flag. I don't really have, so, really it depends on, personally, I would trade a 15-minute chart. I think 5 minutes great. And two things. I would pick one time frame with no more than 20 bars in 1 hour. Trade that. And if you're having trouble, I would trade a little smaller. The issue is when we, look at this. This is the channel. And if you're selling anywhere down here, I would put my stop here. If I sold, I would either get out above here or use a wide stop. And there's a whole lot of things I want to talk about, such as, and I'm going to get off topic if I do it, but I'll mention it real quick, such as, measured move downs. The market is constantly searching for equidistant moves. So you sell this close, stop up here or up here, go for a measured move. Well, the issue is you may not get a measured move, and plenty of traders will buy, stop down here, and go for a target up here. So, Al has his new course out. It's certainly worth it. It's worth watching. But so all I'm going to say is, excuse me, I'm getting really tired, and it's almost 1 a.m. So it's getting kind of hard to make this video. But if you are having, number one, you need to get Al's course. It's certainly worth it. I think they do payment plans, but he can explain this a lot better than I can. And I'm nowhere near where he's at, so you need to do that if you have not. Second, I want to ask yourself, I think you know where the stops go. And to me, I think you're using tighter stops because of the risk. And I could be wrong on that. But the reality is, every tick, it does not matter where you enter. And I've said it before and I'll say it again. The reason why it does not matter is because every tick changes the math. If I sell here, or so if I sell, if I buy this close and put my stop all the way down here, that's no different than buying this close and being up here. The risk is the same. I have an open profit. Technically, if I buy here, I have an open profit, but at the same time, it's my money. So if I buy here, stop down here, my risk is the same. And until you really accept that, that's something you really have to accept. And I'll explain why, in upcoming videos. But the reality is, you can enter on any bar. If you can sell this close, or if you sold here, you can sell here, and you get more down. You can sell here, but again, tight channel, you're getting low in the range, probably buyers, and test somewhere up here. It's trading range, and that's what happened. So I don't have the, you know, I'll talk more about this. I just really I wanted to post this video tonight to, give a short kind of summary of my thoughts. I will certainly make a, longer video soon. I'll certainly make one tomorrow or the day after, sharing more of my thoughts, but let me just give you a summary because I've really got many, many thoughts. And that is, think about fractal mathematics. This is a tight channel. And it's going to look different. If we look at a daily chart, we see a much different picture. If we look at, let me go to this chart. This is perfect. 240-minute chart of the euro dollar. Well, here's the deal. First thing I would say is take one market and take one time frame. Really just take one time frame and only trade that time frame. Don't, it's easy to get caught up in a 5-minute, 15, 20-minute, 60-minute. Just pick a chart. If I'm trading this chart, I'm not going to look at the daily chart or 60-minute chart. All I care about is this right here. So, tight trading range, we're at the top, probably going to get a pullback, but probably always in long, and you may get some sort of measure move up. But again, bad follow through, big bull breakout, bad follow through, high in the range. So probably sideways. Anyways, for your specific question, number one, trade a little smaller. And if you are trading small, then and you're comfortable with it, then you need to use the right stop. And as far as scaling in, you don't need to scale in, and you got to think about the math. If when you buy this close or this close, stop down here, you're not going to get 2-to-1. And, it doesn't make it a bad trade though. If you sell all the way down here, well, your risk is up here. But the first reversal up will fail, and you'll probably get a scalp. Even if you sell here, let's the euro dollars, you probably won't. I'm thinking this is the end. But anyways, the bars are small, and you're low in the range. But my point is that it depends on the market cycle. If you want high probability, you're going to have to risk more. You're going to have to use wide stops. And there's no real way around that. If if I sell below this bar, but my stop one tick above here, then, it's an okay trade, and, maybe you got 2-to-1. But, you obviously have higher probability. You sell, put your stop way up here, and go from there. But the reality is 2-to-1 is often the minimum, and I don't think you're really, think about the trader's equation. You're not, if you take a high probability trade, what is the trader's equation? It's probability of success times the reward minus the probability of failure times the risk. If that yields a positive number, you'll make money. If it yields a negative, you'll lose money. It's really that simple. And the reality is, trading, general, it's 60-40, 60% chance you win, 60% chance you lose, 40% chance you win, 40% chance you lose. And, you know, 90% of the time, that's the way the market is. 10% of the time, you get a strong breakout and price is going to go a little bit lower. But it quickly goes back to 90% of 40-60. So, there's really no, I don't know, Forex is different. I don't use as many stop entries, and in part because, excuse me, I keep yawning, but in part it's just easier to sell at the market, and you know you've got to deal with the spread and all. There's just so many variables with Forex, but in general, I wouldn't worry about it. And one moment. Also, forgot to mention this person. He also said, by the way, he does not use wide stops and scale in. And, he was saying, if you think this would help my management, then I'm certainly willing to consider doing that. And the truth is, it will. Think about it. If I am, just think about the logic behind that. If I'm willing to use a wide stop and incur more risk, I should get higher probability, and that's just simple risk reward. If I use a wide stop and scale in one time lower, my probability has to be higher, has to. And the question is, does it offset the risk of failure? So, the answer to that question. He's saying, I feel like you're asking, and again, I might be completely off. Please let me know if, please reach out to me again. You can email me, reach me out in Google+, comment on the YouTube channel. However you're watching this, video, contact me on Al's website, brookspriceaction.com. But, think about it. If you trade small, or if you use a tight stop, it's less trade management. So it's going to be lower probability. If I buy above here, and then buy more here, and get out all up here, I have to incur risk. I've got to trade smaller, so I've got to earn something for the work, and that's probability. If I buy above here, which I would not do, or if I buy above here and go for 2 or 3 times my risk, I can trade larger. And I'll make more on the times I win, but I'll lose more frequently. So, the truth is your management will be better. Yeah, I don't know. It sounds like if you're taking these swings, you've got to go for 2 times the risk minimum, and you have to think about it this way. If we sell this close and put my stop all the way up here, or if I sell this close, stop up here, do I need to go for 2 times my risk? No, because the probability is so high that it's going to go a little bit lower. Traders think in terms of actual risk. They think about, what are the odds price goes 20 pips lower before it goes 20 pips higher. Nobody, a lot of traders will get out. Well, they will, if they sell, they'll get out way before their stop gets hit. And they'll get out because the premise changes, If I sell here, I may hold above this and think tight enough channel, first level fail. Same thing here, you know. But if I did, I'm gonna get out in here because my premise is changing. So, you know, I hope that makes sense. You're just not gonna get you're not gonna get a 2 to 1 when you have high probability. You know, generally speaking, and he's talking about 2 to 1 in initial risk. Generally speaking, when you have high probability, you have a bad risk reward. When you have a low probability or a low risk reward, I'm sorry, let me restate that. When you have high probability, you have a bad risk reward. Your probability is high, but your risk is big, and your reward is small. Potential reward. When you have a good risk reward, generally your probability is small, it's low, your risk is small, but your reward is big. And the problem I think with most traders that they face is they do something in the middle. They're, you know, their risk reward is neutral and their probability is low, or they have a really high, you know, and when I say neutral, they have a high, a 1 to 1 risk reward basically on a low probability bet, or they have a good risk reward, low probability trade, but they scalp out. So, or they have a high probability trade, and I don't know, they buy, price pulls back, they buy, don't take the profit, price pulls back and stops them out. But that's bad management. So I hope this helps. I'll work on making another video over this. Please feel free to ask some more questions. But that's all the time I really have, and I'll try and think of more examples with wide stops and scaling in. But the reality is, wide stops are going to help you, and I'd recommend them. All right, thanks.